The Indian stock market witnessed a bloodbath today as the benchmark indices Sensex and Nifty plunged sharply. The Sensex, after plummeting over 650 points earlier in the day, closed at 77,860.19, reflecting a decline of 548.39 points, or 0.7%. The Nifty also mirrored this downward trend, ending the day at 23,559.95, marking a drop of 178.35 points, or 0.76%. This significant downturn eroded investor wealth by a staggering 6 lakh crore rupees. The sharp decline in the Indian stock market is a cause for concern for investors. The Sensex and Nifty are considered barometers of the Indian economy, and their decline suggests that investors are losing confidence in the India growth story. The decline in the Indian stock market is not an isolated event. Global stock markets have also been under pressure in recent times. However, the decline in the Indian stock market has been more pronounced than in many other emerging markets. This is a worrying sign, as it suggests that India may be losing its attractiveness as an investment destination. Adding to the woes of the Indian economy, the Indian rupee hit a new all-time low against the US dollar. The rupee plunged 44 paise to settle at 87.94 against the greenback, surpassing its previous record low. This depreciation was fueled by concerns over the US's aggressive trade policies and losses incurred by other Asian currencies. The rupee's fall is a cause for concern because it makes imports more expensive, which could lead to inflation. It also makes it more difficult for Indian companies to repay their foreign debt. The Reserve Bank of India, or RBI, has been intervening in the foreign exchange market to try to stem the rupee's fall. However, these interventions have had limited success. The RBI is caught between a rock and a hard place. If it raises interest rates to try to support the rupee, it could further damage the economy. Foreign portfolio investors, or FPIs, continued their selling spree in the Indian market, pulling out a massive 85,369 crore rupees from Indian equities in 2025. This exodus has been a significant factor contributing to the market downturn. Despite the Reserve Bank of India's rate cuts and the government's tax-saving measures, foreign investors remain wary of investing in India. The strengthening US dollar, with its index soaring above 108, alongside attractive yields on US bonds, particularly the 10-year Treasury note exceeding 4.4%, has made investments in the US more appealing compared to emerging markets like India. This shift in investor sentiment has led to a significant outflow of foreign capital from the Indian stock market. The flight of foreign investors is a sign that they are losing confidence in the Indian economy. This is a worrying development, as foreign investment is crucial for India's growth. The government needs to take steps to restore investor confidence, such as by implementing structural reforms and improving the ease of doing business. While the overall market sentiment was negative, sectoral performance painted a mixed picture. The real estate, healthcare, and metal sectors emerged as the biggest drags on the indices. The Nifty Pharma Index declined by 2.10%, with companies like Alchem and Ipca Laboratories facing pressure due to weak earnings and concerns about US tariff policies. The banking and financial services sector is also grappling with challenges, including high funding costs, rising credit costs, concerns about asset quality, and sluggish loan growth. This has weighed on the performance of banking stocks. Despite the overall market downturn, some sectors, such as information technology, or IT, and consumer staples, have shown resilience. This suggests that investors are still optimistic about the long-term prospects of these sectors. However, the overall weakness in the market is a concern, and it remains to be seen whether these sectors can continue to outperform if the market decline continues.